Welcome back to our explainer series on ASC 235 and the notes to financial statements. In our previous lesson, we unpacked the complexities of commitments, contingencies, and disaggregation, really focusing on what absolutely must go into those notes and the critical difference between a probable and a reasonably possible item. Today, we are jumping right into section 6 of 7, tackling 3 incredibly crucial topics: how to fix mistakes when things go wrong, how to properly organize your disclosures so they actually make sense, and how international reporting standards can completely shake things up. All right, here's our roadmap for today. First up, error corrections and changes. Then, structuring financial statement notes. And finally, US GAAP versus IFRS. Let's dive right into Section 1, Error Corrections and Changes, and navigate the somewhat stressful waters of ASC 250. Let's be real for a second. Discovering an error in a prior period financial statement, that's a massive, high-anxiety moment for any accounting team. It happens to the best of us, but how you handle it requires absolutely precise execution. The crux of the whole issue is determining materiality. When you find a mistake, you have to run it through an evaluation. If that error is deemed material, well, you're forced into a retrospective restatement. That means officially going back and reissuing past financial statements. It's a huge lift. But on the flip side, if the error is immaterial, say just a minor classification oversight that doesn't really change the big picture for the reader, you can simply treat it as a current period adjustment. You fix it right now and move on. Now, what if you do have to bite the bullet and restate? Well, you absolutely cannot hide it. Transparency is literally the rule of law here. Your notes have to explicitly and prominently list 3 things. First, the exact nature of the error. What actually went wrong? Second, the effect of the correction on each prior period presented. You have to map this out line by line so users can see exactly what changed on the balance sheet or income statement. And third, the cumulative effect on retained earnings at the beginning of the earliest period presented. You've got to show the math, plain and simple. Okay, so it's not always about fixing errors, right? Sometimes you're just making a change in how you account for things. Imagine you make a voluntary change in accounting principle, like switching your depreciation method from straight line to double declining balance, because it's preferable. That requires retrospective treatment, meaning you have to go back and restate all prior periods to reflect that new method. But if you're merely tweaking a change in estimate, like revising a piece of equipment's useful life from 10 years down to 7 because it's wearing out faster, that treatment is strictly prospective. You only apply it going forward, no time travel required. And guys, this right here is a massive watch-out area. Teams confuse these two concepts all the time, leading to some serious headaches. So let me just reiterate the golden rule. A change in estimate is always prospective. Never, ever restate prior periods just because your estimate got better over time. Your prior estimate was simply your best guess back then. Conversely, a voluntary change in accounting principle is always retrospective. Definitely lock this rule into your memory. Finally, there's a third scenario: adopting a brand new accounting standard mandated by the regulators. Often, they'll allow what's called a modified retrospective adoption. I know, it sounds super complicated, but just follow this simple flow. Step 1, you apply the new standard to your current year only. Step 2, you leave your prior years completely alone. They stay comfortably under the old standard. And Step 3, you add the mandatory transition disclosures to your notes to bridge the gap for the reader. It saves you from restating history, but you absolutely must be crystal clear in the notes about what you just did. All right, so we know how to fix errors, manage changes, and apply new standards. But all of this information needs a home, which naturally begs the practical question: how do we physically organize this massive document so that an investor or an auditor can actually find what they're looking for? That brings us to Section 2, Structuring Financial Statement Notes and Dealing with the Industry Expectation. If you actually open up ASC 235, you won't find a legally mandated rigid sequence for your notes. But don't let that fool you. Here is a snapshot of the conventional ordering the industry absolutely expects. Deviating from it, it just causes unnecessary confusion. You always want to start broad. Note 1 is almost universally the summary of significant accounting policies. Then, you generally follow the flow of the balance sheet and income statement, moving through cash, receivables, inventory, up to major items like revenue in Note 2, long-term debt around Note 8, our old friend commitments and contingencies around Note 12, and you typically wrap up the entire shebang with subsequent events as your final note. It's just a logical journey from the foundational rules down to the specific line items. Now, what's really crucial here is the real-world consequence of all this ordering. As you're drafting, you're going to insert cross-references on the face of your balance sheet saying things like accounts receivable, see note 4. But during those final, chaotic days of closing the books, note numbers can and will shift as things get outed or deleted. Listen, a mismatched cross-reference is a massive red flag for auditors. It just looks sloppy and completely undermines trust. So your final period on checklist must include a manual tie-out, verifying that every single reference matches perfectly. Okay, so that covers standard domestic filings. The structure makes sense, the rules are clear. But things get incredibly tricky if you are a subsidiary reporting up to a parent company located in London, Toronto, or Sydney. Suddenly, the US GAAP playbook isn't the only one you need to know. Which leads us to Section 3, US GAAP versus IFRS, and exploring note disclosure differences. While both US GAAP and IFRS share the ultimate objective of making sure financial statements aren't misleading, how they actually get there can be quite different. Fundamentally, it comes down to philosophy. US GAAP is heavily rules-based. Specific Accounting Standards Updates, or ASUs, mandate precise, strictly enumerated disclosures. You are essentially working your way down a very detailed checklist. IFRS, on the other hand, is principles-based. It leans heavily on your professional judgment as the preparer to decide what is truly necessary to present the information fairly and help users understand the numbers. When we put specific topics side by side, we start to see some slight yet super critical nuances. Take going concern, for example. Under US GAAP, you evaluate the entity's ability to survive for 1 year from the date the financials are actually issued. But under IFRS, you evaluate at least 1 year from the balance sheet date. That is a completely different starting clock. For key estimates, US GAAP is a bit less prescriptive on format. IFRS, however, has an explicit requirement to detail the specific risks of material adjustment within the next year. It's much more prominent. Luckily, though, some areas, like segment reporting, are substantially converged, meaning they both use a pretty similar management approach. Now, if you are a dual reporter, meaning you have the joy of preparing statements under both frameworks, you really need to watch out for these IFRS-only gotchas. IFRS explicitly requires you to disclose your capital management objectives, policies, and processes. There's no real US GAAP equivalent for this. Furthermore, IFRS requires detailed disclosure of key management personnel compensation. We're talking broken down by categories like salaries, pensions, and stock-based comp. Again, under a standard US GAAP private company filing, you generally wouldn't see this. You literally have to build these disclosures from scratch if you're reporting internationally. So you now know the mechanics of correcting errors, how to structure your notes logically, and how to spot those sneaky international differences. But as global business just keeps expanding, it really makes you wonder, will we eventually see one unified global framework, or will this tug of war between strict rules and professional judgment last forever? Well, whichever standard you're using today, the ultimate test of all this hard work is the audit. Are your notes truly structured to withstand an auditor's final, rigorous checklist? That is exactly what we will cover in our 7th and final explainer. You definitely won't want to miss it. Until then, keep those disclosures clean and your cross-references perfectly tied out.